All right, one of the stock stories we are tracking today in Toronto is a Bay Street player, Canaccord Genuity, which is actually a global investment firm, but obviously we track what's happening on Bay Street, M&A activity, IPOs, and that is certainly part of the Canaccord story, but they've also been growing their wealth management business worldwide for a very long time, which was reflected in the quarterly results. In the boardroom, an update as well. Daviau, the CEO, is also going to be stepping into the chair role, and he joins us here in studio to talk a little bit more about what's happening in the business. A busy time for you guys. Maybe we should just start with this boardroom dynamic and how that all came about.
Sure, that's just an evolution. As you know, we were looking at a privatization some time ago. That's not on the table anymore. We're trying to drive value for all our shareholders going forward. We put in place, I don't want to call it an interim board, but a board until our next meeting, which is the meeting coming up. We put in place a 5-person board now, very strong board. We brought on some regulatory expertise with a woman by the name of Cindy Tripp, who was on the OSC board until recently, and a woman from the U.S. in the wealth business. So a very focused, agile board to create value and to kind of respond to the market opportunities. I've taken on the chairman role as an addition to the CEO role. I'm the only non-independent on the board. The other 4 are completely independent. We obviously have a lead independent director as well, and Michael Orbach. So we're pretty excited by the new board in terms of driving value for shareholders. So
when you were having those conversations tied to taking on this additional role, does it invite a conversation on where you want Canaccord to be in 3 years and 5 years over the next decade?
No, not really. It's how do we create value for shareholders quickly? And really, the role of a chairman is to facilitate the information flow from the company to the board so they can react quickly. The easiest way to do that is have someone like me who knows the company really well and what we're doing, communicate that to the board so we can react fast.
So let's talk about what's happening with the company.
Sure.
And I mentioned at the end of the day, there's these, I'm simplifying it, but there's 2 main parts of the business that's sort of directly tied to the heartbeat of what companies want to do in the capital markets, and then the other part of the business, which is all about wealth management. How would you characterize what's happening with each side of the business?
Yeah, well, again, the business that we've always been investing in is our wealth management business. We hit record high asset levels now. We've got over $100 billion, $104 billion. Each of our key wealth businesses grew this last year between 7 and 18%. So great growth. We made $140 million of net income, pre-tax net income, in those wealth businesses. They've had a phenomenal year, notwithstanding a choppy market. They've had a phenomenal year. And it's because we continue to invest, we continue to grow, we continue to bring on phenomenal advisors. We just bought a business in the UK called Cantab, another little acquisition. I call it a tuck-in acquisition in Cambridge, so with a bunch of financial planners. So we continue to invest in that business. It's going perfectly according to plan, and it's great. That's a predictable business. That's a business that we can continue to invest in, and we know what we're going to make. The capital markets business has always been a volatile business. You've seen what's happened in new issue flows. You've seen what's happened in the lack of IPOs. It's picking up. It's getting better. Mining was particularly strong over the last quarter and into this quarter, mainly because you've seen interest rates come down a little bit. You've seen manufacturing increase. That leads to people wanting to own mining stocks. Those are early stage cyclical stocks. We've seen a huge pickup in mining activity. We're the #1 mining underwriter in the world, so we've obviously benefited that primarily in Australia and Canada. And those were our 2 profitable capital markets businesses last quarter. The U.S. and the U.K., we lost a little bit of money in each market, mainly because they don't have the benefits of that mining input. So what we're hoping to see is more of a return to risk capital. Some of the smaller tech stuff, healthcare stuff, sustainability stuff, consumer stuff. That's going to happen. I don't know if it's this quarter, next quarter, the quarter after. Those are more late-stage recovery type opportunities where people commit capital to them. I think it'll happen soon, though.
But at a time when, you got stock markets at record highs, you've got central banks starting to cut interest rates, economy's not collapsing, this idea of already hitting the trough, if you will, in the cycle for M&A and IPO activity. We're on the upswing, in your opinion now?
Yeah, 100%. We're through the trough. We're definitely kind of going through into that upward cycle. But again, just because markets are hitting record high, there's been more concentration in that top 20% of the stocks than there's ever been. 58% of the market cap is covered with the top 20% of the stocks. So you need that to broaden out into the smaller cap area, the areas that we dominate. And that's going to happen, and that is happening.
So that kind of gets us back to this idea of how many Canadian companies are going public, listing, and you've been fairly vocal, quite frankly, about your views on the environment here at home, the environment for growing business in Canada, and growing companies and companies going public. Why have you felt that you had to speak out on these issues?
You know, we like our position. We like being the dominant independent in Canada. It's not that we don't have some other good independent firms, but we're clearly the biggest by a mile. And what we do is we facilitate entrepreneurs raising capital in the marketplace. That's what we're really good at. And most of those are, you know, smaller companies, $100 million, $200, $300 million market cap companies that grow into the dominant market leaders. And what I've thought in Canada is we've just really lost our edge on that. We've lost our ability to allow those small companies to grow, because if they trade poorly or they have poor valuations, they get bought out. They'll get bought out by private equity, they'll get bought out by a US firm, they'll get bought out by somebody, and then we lose those companies, and we lose that here. And my vocalness really came from the fact on this capital gains tax, which goes exactly the opposite of what you would do. Like, if you were going to tax, these companies don't pay dividends. The only way to make money on them is their share prices go up. And if you're going to tax that share price going up more than you're going to tax other ways that they could return capital, then you're creating a disincentive. And these are companies that don't have to be here. A tech company doesn't have to locate in Canada. A healthcare company doesn't have to locate in Canada. An interesting sustainability company, they could locate anywhere in the world. And they could attract capital and hire people anywhere. Banks have to be here, rail companies have to be here, airlines have to be here, insurance companies. Those are the stable companies. And if you look at the Canadian index, the top 15 companies here, the average age is 100 years old. In the US, 30% of the companies are less than, they were formed in the 70s and 80s. You know, Facebook, Google, all the names that you're familiar with. So we've got a very old economy here, and unless we're going to support that growing economy, it's only going to get worse and worse, and we won't have those new companies come up. So that's why I've been relatively vocal in it.